Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This week's big international news is the resurgence of the COVID-19 pandemic. In the United States, where President Trump is refusing to participate in the traditional transition process, numbers are skyrocketing. Most of the European Union is already in some form of lockdown, and even countries like Japan and South Korea, which had apparently managed to flatten the curve, are experiencing a rise in infections. As of last night, 57 million people have been infected by COVID-19 worldwide, and more than 1.4 million people have succumbed to the virus. The United States remains the country hardest hit, with nearly 12 million infections and over 255,000 deaths. India, Brazil, France, and Russia make up the Big Five. Europe is certainly the epicenter, and South Africa has slipped down to 15th position in terms of recorded cases. Most of the countries that have had second waves of COVID-19 infections have quickly and decisively implemented lockdowns of some or other kind. This has generally led to a flattening of the curve. Sadly, in the United States, there has been no coordinated federal response, and new infections are now totaling about 160,000 per day. Sadly, a rise in the number of new infections will eventually translate into a rise in the number of fatalities. As could be seen on the previous slide, prompt and decisive action to flatten the curve has generally helped to soften the blow in most countries. The exception, once again, is the United States, where more than 250,000 people have now succumbed to the disease. The COVID-19 second wave is no longer just a problem of the West. There's also concern in countries like Japan and Korea over a rise in new infections. Moderna announced that its COVID-19 vaccine is more than 94% effective. China has meanwhile established a 15-member Pacific trade bloc which excludes the United States. The Japanese and Chinese economies continue to recover, even as the UK and Europe face a double-dip recession. US unemployment is at its lowest level since February. McKinsey's monthly survey of global business confidence measures companies' expectations with regard to profits and demand for their products. This infographic shows just how much more bullish business leaders have become about the future. In September and October, more than half of the respondents felt confident that their turnover and profits would both rise over the next 6 months. China's success in combating the COVID pandemic has enabled its economy to recover faster and more comprehensively than any other major economy. Chinese exports are approaching their pre-COVID levels. Retail sales are getting there. Chinese industrial production is already surpassing its pre-COVID levels, and property investments in urban areas has turned positive for the first time this year. The reopening of the American economy over the summer months has seen a sharp increase in the number of job opportunities available to Americans. Unemployment has now fallen from a peak of over 10% to well below 7%. Sadly, there are still 10 million fewer job opportunities available than before the onset of the pandemic. The prospect of a COVID-19 vaccine has energized all the major US indices, and the Dow Jones has just had its quickest recovery from a bear market in 29 years. More traditional companies have now joined tech stocks in making the running. The indices of the rest of the world are now following suit, and it's not just Wall Street doing the running. Tesla will be included in the S&P 500 next month, and the gold price is falling even as the oil price is rising. Berkshire Hathaway has rotated out of banks and invested heavily in pharmaceutical companies. It's hardly a mystery why the United States stock market has done so well in recent times. The historically low real interest yields offered by bonds and cash has given investors very little alternative but to invest in equities. This has allowed for the historically high price-earnings ratio of the S&P 500 to develop. It's simply the only show in town. It's not just low interest rates that have been supporting the US equity market. Quantitative easing, otherwise known as printing money, has also played a major role. What it actually entails is that the United States Federal Reserve buys the bonds of private issuers on very favorable terms in order to inject liquidity into the economy. The Fed currently owns bonds worth the equivalent of a third of the US GDP. After the sharp sell-off sparked by the COVID-19 pandemic, the US equity market recovered a lot quicker than the rest of the world, largely due to America's status as a safe haven. In recent times, however, the return of risk appetite and optimism over the likelihood of a COVID-19 vaccine being found has seen the gap between the MSCI World excluding America and the S&P 500 narrow. This infographic depicts just how the same set of economic factors affect gold and oil differently. Gold is traditionally seen as a hedge against uncertainty and inflation, and therefore the gold price did exceptionally well when the gloom and doom was at its highest. The oil price, on the other hand, needs a strong underlying economy, and the announcement of COVID-19 vaccines has seen the oil price rise even as the gold price has come off. Looking ahead, we believe that global economic activity will only return to pre-COVID levels in the second half of next year. Equity markets will be supported by cheap money and economic recovery, with gains no longer limited to only technology stocks. As fear subsides and is gradually replaced by greed, emerging market equities and bonds should attract portfolio flows. A more settled investment climate will, however, not be good for alternative assets like gold and cryptocurrencies. Here at home, the National Prosecuting Authority and various investigative bodies continue to make progress in the struggle against the scourge of corruption and state capture. It remains to be seen, however, how many of the people currently being arrested or threatened with arrest will actually end up wearing prison overalls next year. As of last night, nearly 760,000 South Africans have tested positive for COVID-19, and nearly 21,000 people have succumbed to the virus. Although there hasn't been a dramatic spike in new infections since the lockdown was relaxed, the past month has seen a gradual rise in new cases. This week, the average daily number rose above 2,000 for the first time. Also concerning is the sharp rise in both infections and deaths in the Eastern Cape and Free State with their poor health infrastructures. Yesterday, the Reserve Bank's Monetary Policy Committee announced that it was leaving the repo rate unchanged at 7.5%. Manufacturing and mining output both rose in the third quarter, but retail sales were down 5.1% year on year. Moody's expressed concern over the impact of COVID-19 on South Africa's economy and credit rating, and our unemployment nightmare just got worse. 1.6 million fewer people were employed in the third quarter than in the same period last year. After a dismal second quarter, dominated by the COVID-19 lockdown, mining output recovered dramatically in the third quarter and rose by an aggregate of 41% quarter on quarter. The most impressive increases were in platinum group metals, gold, and chrome production. Unemployment remains one of South Africa's biggest socio-economic challenges because it also exacerbates two other associated problems, those being poverty and inequality. According to the official or narrow definition, unemployment rose to 30.8% in the third quarter. Don't be misled by the number of 23.3% in the second quarter. That was simply because the lockdown precluded people from looking for work. The number of South Africans employed in the formal and informal sectors rose by 500,000 in the third quarter. Sadly, the number of workers registered as unemployed increased by 2.2 million, and the number of discouraged work seekers grew by 200,000. If the latter number is included, nearly 39% of South Africans of working age are currently unemployed. It's been a good week on the JSE so far, with the all share currently around 57,000. Bond yields and the rand both remain strong, and SPAR had its best one-day ever rise thanks to strong revenue growth in the third quarter. Naspers, however, warned that its half-year earnings would be lower, and thanks to strong data sales, Vodacom was able to hike its dividend. 91 Asset Management suffered a nearly 7 billion rand outflow in the 6 months to September, and in a statement, Goldman Sachs announced that it was upbeat about the rand and South African banks. The rand is currently in a sweet spot. Thanks to a positive balance of payments and net inflows into our capital markets, the rand is one of the best performing emerging market currencies, along with the Indian rupee, the Indonesian rupiah, and the Chilean peso. The rand is currently trading at levels between 15.50 Rand and 15.60 Rand to the US dollar. Last week saw net foreign purchases of both South African bonds and equities. On the bond market, foreigners were net buyers to the tune of 3 billion rand for the week, and the JSE attracted a similar amount of money. The main reason for the recent strength in the local bond market is the fact that South Africa offers such attractive real yields. With inflation currently at around 3%, this means that the real yield on the 10-year bond is around 6%, and in the case of the 20-year bond, around 8%. Banks, along with listed property, have been the worst performing sectors on the JSE for the year to date. The market is justifiably concerned over the impact of bad debts on banks, and the sector lagged far behind the rest of the JSE when the market started recovering. Experts are now claiming that banks offer great value and that all the bad news is already priced in. The sector has enjoyed a strong week, but time will tell whether this is the start of a sustainable recovery. Looking ahead, we expect equity markets to remain volatile and fixed income yields to remain next to nothing for the remainder of this year. In this sort of environment, gold could be an interesting diversifier. The local equity market looks cheap, but could become even cheaper unless the local economy recovers. The rand remains a structurally weak currency, and as government's debt balloons, the run in local bonds might not continue forever. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.